In recent months, a new buzzword has taken over the worlds of finance and crypto: RWA. Whether you scroll through crypto forums or mainstream financial news, this acronym pops up again and again. Some hail it as the next big wave, while others suspect it's just another shiny tool to scam retail investors. So what exactly is RW? Why has it become such a hot topic now? And most importantly, will it truly reshape finance and trade? Or is it just another temporary hype cycle? Let's unpack this by looking at its past, present, and future. Part I: Past, from blockchain utopia to financial experiment. RWA stands for real-world assets. At its core, it refers to the tokenization of real-world assets. Things like real estate, government bonds, commodities, or invoices, so they can exist and be traded on blockchains. The idea dates back to the 2019 decentralized finance boom. Back then, crypto markets were dominated by native tokens like Bitcoin and Ethereum. But there was a problem: these assets were volatile, unstable, and too speculative to support large-scale financial activity. That's when projects like MakerDAO stepped in. MakerDAO, which issues the stablecoin DAI, asked, what if we could back stablecoins not only with crypto, but with real-world collateral, such as real estate or business loans? Soon, startups like Centrifuge and Maple Finance began experimenting with tokenized invoices and securitized loans. These early experiments laid the foundation for what we now call RWA. The real breakthrough came when projects like Ondo Finance started tokenizing U.S. Treasuries, with U.S. bond yields rising above 4 in a high-interest rate environment. Treasuries became a safe and attractive asset by bringing them on-chain and breaking them into smaller tradable tokens. RWA suddenly looked like a bridge between the crypto world and traditional finance. In other words, RWA was born out of crypto's search for stability. It wasn't a marketing gimmick at first, it was a practical attempt to connect digital finance with real-world value. Part II: The present. Why has RWA become a buzzword? 2025, RWA has exploded in popularity. There are 4 main reasons. 1. Macro environment: global interest rates remain high. A 45 yield on U.S. Treasuries is irresistible compared to the zero yield of holding crypto assets. Tokenized treasuries, or gold, instantly became the hottest narrative in DeFi. 2. Institutional adoption: giants like BlackRock and Franklin Templeton entered the space, launching tokenized funds. Their involvement gave RWA an aura of legitimacy and made headlines across financial media. 3. Regulatory clarity: the EU's MiCA framework, Singapore's Project Guardian, and Hong Kong's tokenized bond pilots all gave RWA a clear regulatory pathway. For once governments weren't banning crypto, they were supporting its real-world application. That's why RWA suddenly became a high-frequency buzzword. It checks every box: macro tailwinds, institutional backing, regulatory support, and a shiny new narrative. Part 3: The future: scam or systemic change. So is RWA just another fancy way to scam retail investors? Or could it truly transform the way finance and trade operate? The answer is both. 1. The risks: how RWA could be exploitation. Liquidity problems: many so-called RWA tokens trade thinly. Investors might buy them but struggle to sell. Custody risk: if the real-world asset isn't properly safeguarded or audited, the token may be nothing but empty promises. Information asymmetry: retail investors rarely have the tools to verify whether the on-chain token actually corresponds to the promised off-chain asset. These risks create fertile ground for pump-and-dump schemes. Without strong regulation, RWA could absolutely become another cycle of hype and disappointment. 2. The opportunities: how RWA could redefine finance. Yet dismissing RWA as pure scam would be short-sighted. Its potential is massive. Lowering barriers: real estate tokenization could allow everyday investors to buy a slice of a skyscraper for $500. Instead of needing millions, global capital flows, tokenized treasuries, or gold can be traded. 247 worldwide without relying on traditional exchanges. Unlocking liquidity. Illiquid assets like invoices, private loans, or artwork could suddenly enter a global digital marketplace. This is more than speculation, it hints at a structural shift in capital markets. 3 new rules for global trade. Imagine this. A small African company issues tokenized invoices and directly attracts Asian investors, bypassing expensive bank loans. International trade settlements use tokenized treasuries or gold as collateral, speeding up transactions and reducing costs. Your everyday digital wallet not only holds stable coins, but also tokenized stocks, bonds, and even fractions of fine art. If these scenarios materialize, RWA won't just change finance. It could reshape global trade and the movement of capital. Conclusion: a fork in the road. So is RWA a new scam or the next big thing? The truth is, it could be both. If left unchecked, it's just another buzzword for scammers to repackage old tricks and exploit retail investors. If built on transparent custody, solid regulation, and genuine institutional involvement, it could evolve into the backbone of tomorrow's financial system. From its past as a DeFi experiment, to its present as a regulatory and institutional hot topic, to its future as either a scam or a paradigm shift, RWA stands at a crossroads. It might turn out to be just another passing fad, but it might also become the rulebook for how money, assets, and trade flow in the 21st century. For ordinary investors, the lesson is clear: don't blindly chase hype. Always ask, am I buying a real-world asset on Caner, just a digital illusion?